What's up, good people? It's your boy Larry Jones. Hey, if you're new to the page, go ahead and hit the like, subscribe, notification bell. Make sure you hit all. I'm not going to do the intro. Today I have a guest, Alec Rosario. You guys always hear me say I am not a financial advisor. Well, today we actually have a financial advisor. And full disclosure, I've been knowing this gentleman most of his life. His dad was the best man in my wedding. And so I asked him to come and answer some questions for you guys, because there's a lot that we need to talk about while the market is where it is now. Remember, we're building a solid foundation, and there's some very important things that we need to know. Okay, but first, you guys know I want you to check out the links below. Webull, just $5 to open up an account. Pre and post market trading, fractional shares. Click the link, download it. You're going to get more in that in free stock, and they have a promotion. You will get up to $2,300 in free stock. Also, the merch did very well, and this is the $5 cup of coffee for those of you that's doing the $5 a day challenge. Go ahead and get that $5 cup of coffee. Keep it as a reminder, and make sure your kids don't steal that $5 out of there. I actually have another one upstairs I drink coffee with. Let's get right into it. So remember, if you've been investing for a while and you're doing really well, that's fine. But there's a lot of new investors, and a lot of you, there's been millions of new accounts, thanks to brokerages like Robinhood and things like that. That there's millions and millions. I think Robinhood has 22 million now accounts. And so, but there's some basic things that we need to do to balance our portfolios and not just look at the hot stock. Now, I'm not suggesting that you load your portfolios up with these funds that we're going to be discussing, but I am saying and suggesting that you have a portion of it in. I don't care if you start with 5%, start with something, because you're going to find out, especially for those of you that's new, some of these funds are going to outperform you, and it's especially long term, right? So it's good to just bet on the market. All right, so we're going to talk about 3 specific types of funds, right? We're going to talk about mutual funds, index funds, and ETFs. Okay, so first question, you know what, I'm sorry, y'all, I'm just jacking this up. Alec Rosario, go ahead and address the people.
Hi everyone, Alec Rosario. Truly a pleasure to be here. Thank you for trusting me with your team here. I'd love to, I'm very excited to speak with you guys today and be here, part of the channel. So thank you, Larry. I appreciate you.
No problem. And for those of you saying, how old is he? He's about 10 years older than whatever age you think he is.
That's right.
He's about 10 years older.
That's right.
He just got good genes.
Great hair too.
He got roots like tree roots. I wish my roots were that strong. But anyway, let's talk about funds and how these funds actually how they perform over a period of time. Some of these funds, average over 10-20 years about 10% a year. Sure. One of the things that happened to the market last year, because it was a bull market, is it made a lot of people greedy. And so people thinking, hey, if I'm not making 30, 40, 50%, I'm not doing anything. That's not so. You put your money in a savings account, the cost of living is higher than what they're paying you in a traditional savings account, right? So let's start with a mutual fund, because most people have heard about a mutual fund,
sure,
but don't understand what it is. Could you explain what a mutual fund is?
I will do my best. Yeah. So if I may just use this as an example, and again, don't forget, your $5 cup here.
Yeah, man. I'm gonna pay you for that.
There
That
you
was
go.
really good.
We'll put it
Just
right
put
in.
it right in there.
So I always explain it like this. So buying an individual stock is like buying this single pen, right? It's going to be an individual company. It's publicly traded. They're in the market to create revenue and therefore profit for themselves. But sometimes individual companies don't do as well as we might imagine, and that could happen for any number of reasons, right? They get bought out. Steve Jobs and as a CEO passes, and so there's uncertainty in the direction, right? We've all seen fluctuation with individual stocks, right? And so instead of betting your entire retirement portfolio on one company, what a mutual fund does is it puts it in a cup like this, and then you've got 100 different companies, 500, 1,000 different companies within the cup. And so now instead of buying the individual stock, you're buying the cup. And the cup is going to go up and down based off of the general market as opposed to that one single stock. So that's the concept of a mutual fund. And
okay.
then
So now the term mutual fund. What's mutual about them? Is it just stock all over, or I gotta play? I know the answers to these questions. I gotta play devil's advocate. Is it stock in different areas, or is it stock in the same area? Explain that.
Yeah, of course. So there's different companies that are going to be within that portfolio. So again, you might have 1,000 companies, but each of those companies are going to play a different role, right? There's different industries, different sectors, and all of those companies are going to play a role within the portfolio. So you might have a fund that's specifically trying to grow and use growth companies, right? With value add companies or growth companies, dividend paying companies, but it'll focus within that vein, if you will, and create the portfolio around those types of companies. Does that answer your question?
Yes. Okay, so now let's deal with mutual funds and index funds.
Okay.
What's an index fund?
So if a mutual fund has 100 different companies in it, there's someone on a daily basis going into the portfolio and exchanging stocks in and out of the portfolio. So for example,
so someone else chooses what stock are going into that fund.
Correct. Yep.
And it's actively managed
on a daily basis. Yep, from 8:30 a.m. to 3 p.m. Central Standard Time. That is being traded by an individual or a team of people who normally have a bunch of letters behind their name, but they're highly compensated to do that individual trading. Right? They've created. They're almost the babysitters of your money during the market in that mutual fund.
Okay.
Does that make sense?
It does.
So what an index fund is essentially takes away that individual or that team from the fund, and so it'll basically mimic what the market is doing. The S&P, the NASDAQ, Dow Jones, what it'll do is take a snapshot or a picture of those things, and then it'll say, okay, let's set this up. We're going to put it in there using these indices, and then we're going to leave it there for a month. 2 months, a quarter, a year, semi-annually, all of it. But they're gonna leave the fund alone.
Gotcha.
And not invest it on a daily basis like the mutual fund does.
Okay. And the third one, an ETF.
Yes.
First, explain what the letter stands for.
Yes, Exchange Traded Fund is what ETF stands for. Very, very similar to the index fund, in that it uses the mimicking approach of the S&P, the NASDAQ, Dow Jones. It takes a snapshot of those things, and then it doesn't have that active manager every day. So a lot of you have probably heard the active-passive debate. This is what they're talking about.
Yes.
Mutual funds on a daily basis, someone's watching, versus the ETF and index fund, no one's watching on a daily basis. One of the major differences is when the ETF trades and how it trades. First of all, it's traded throughout the market open from 8:30 to 3. ETFs you can buy and sell, and it'll happen real time, versus an index fund, it happens at 3 p.m. Central.
Okay.
So that's one of the biggest differences. And then of course costs, which I think we're going to talk about.
Yeah, let's go right into costs.
Yes.
Okay. Just go right into it.
Yeah, so there's something called an expense ratio. So this is the number that a lot of people consider when talking about investing into these type of funds. The expense ratio for a mutual fund is, on average, across the industry, somewhere between 0.6% and 1% per year. So if I've got $10,000 invested, I'm going to pay $100 when I'm using a mutual fund if it's at 1%.
Right.
On an annual basis. What an ETF, an index fund, because they have that person not managing it on a daily basis, they don't have to pay anywhere near as much.
Right.
So instead of it being 0.6 to 1% on an annual basis, it's going to be 0.3, 0.5,
right,
something like that, maybe 0.15, but a heck of a lot less than the 1% that the mutual fund's expense ratio is
right,
being passed on to the investor.
And I will put in, all ETFs are not created equal.
Correct.
There are some, like the ARC ETFs, that are actually actively managed.
Yes.
And they come with higher fees.
Right.
So you want to check with the fund and the broker to find out what you're getting, before you decide to pull the trigger on.
Exactly.
Right?
Yep, correct.
Alrighty. So those are the basic three things, and it's okay to take a pen and just write the differences down, good people. So now, what fund is best for someone who's 25 and just starting to invest, and what fund is better for somebody who's 55? Yeah.
That's the question, right?
Yes.
I would say this. It's completely dependent on what your style is, what your preference is. But for a younger investor, using lower costs,
right,
generally speaking, is going to work out better for you in the long run, right? Because you've got a high return. Let's just say let's pretend it's 10%. All things equal, it's 10%. So if a mutual fund's charging me 1, and an ETF is charging me 0.1, then over 30-40 years, that difference of 0.9%
right,
is going to essentially be taken away from me as the investor, or you as the investor. So what you want to do, especially if you're younger, is use lower expenses, and specifically if you're not trading it yourself, right? If you're not doing the stock investing yourself, using the lower cost is probably going to be the best bet. Versus someone who's older, closer to retirement,
right,
you want to avoid the losses, and this becomes a little tricky to say, but when I'm close to retirement, or not just retirement, in my 50s, 60s, I want to avoid downturns, bear markets, anything like that. And so that active management, someone babysitting my money on a daily basis, that's hopefully hedging for you, right? They're going to take advantage of the market coming down,
right,
and maybe invest some of the cash in the portfolio. Maybe they'll use some of the other conservative money that they've got laying around,
right,
and take advantage of the upswing.
Yeah, and probably pull back a little on the more volatile stock during the downturn of the market.
Yep, exactly.
So that's the plus you get with an actively managed fund.
Right. Yeah. Versus ETF, the structure is it's passive, so no one's watching on a daily basis. So therefore, when the market comes down, you're going to see no changes to the portfolio.
Oh, ARKK. So I actually love ARKK, and I suggest looking at some of the ARK funds for the younger audience.
Yep.
Because there's some ETFs that are area specific. They're just specific in certain areas or certain industries, right? And so so there's ETFs for electric vehicles. There's an ETF for that. There's ETFs for finance. There's ETFs for, you know what I'm saying? So now you're getting all of these stock, but it's in a specific area. And so there's so many funds out there. If you are 25 and you want to use a mutual ETF or index fund exclusively for retirement, right? And let's say you're young and you're going to put 5% of what you towards a retirement fund,
Sure.
and you don't want to be watching the stock market every day. Is there one fund that performs better than the other over a period of time, or is it just?
Well, again, you want to definitely start with the expenses. That should be number one. Check out past performance. Checking out the money manager, the person that's actively managing it,
Yes.
their performance over the long run. I personally, and let me also say this is not a recommendation, as I'm
Right.
definitely not allowed to do that publicly.
Right.
But there's funds that I personally.
I'm not
use.
your financial advisor, and neither is he until you hire him.
Yes.
But yeah, go ahead.
Feel free to call me, but yes.
Yes.
So, like, I personally, my own money is in American funds. I've got some J.P. Morgan funds. I've got some Franklin Templeton that I really like, but I am very, very aggressive as an investor. So,
Right.
for me, it's really more about where those portfolios are investing.
Yeah.
As far as their theory, their model, their philosophy.
Right.
So the high growth, or a lot of value to be added as far as the
Yeah.
stock price. I'm investing in those.
And the younger you are, the younger you are, generally as a rule of thumb, the younger you are, you have time to
Right.
go towards the more aggressive
Yeah.
stock. And the older you are, you want less aggressive, you want more safe, because you're nearing the age where you want to start pulling money out.
Right. There's 4 generations in my family. I always say this to my clients. So my grandfather has completely different needs from my son, who's 3. My grandfather's in his 80s.
Some of the same needs though.
That's probably true. That's probably true. My grandfather, he's got to be more conservative. It's just, he's on a fixed income, Social Security is coming in, but as far as his portfolio, he needs it to be conservative. My dad's getting close to retirement, not quite there. He's trying to be aggressive for the most part, but then he's got his conservative mind.
Exactly.
I'm super aggressive, pedal to the metal. Same thing for my son. For his college fund, it's very aggressive because I've got 16 years until we're going to use it.
Right.
But for my grandfather, again, going back to it, my grandfather needs to be conservative.
Yeah.
He's going to have some stock exposure through mutual funds and ETFs, but a lot of it is going to be more conservative in nature, which you can meet those needs within any of the funds that we've talked about. Mutual funds, ETFs, index funds all have conservative portfolios that allow you to be, hopefully getting 1 to 4%, but smooth out the ride as far as your investment portfolio.
Yeah. Well, you know what? I'm gonna just switch it right here, because we're gonna chop this up, and I'm going to talk about in part two of this series. We'll talk about maybe setting up these funds in an IRA. Okay, that'll be the next one. But before we go, give me 2 frequently asked questions, and then talk about how people can contact you.
Sure.
He's in the Chicagoland, Northwest Indiana area. Question number 1, though. Say someone, are you licensed by state? So say someone lives in South Carolina that's listening. Will they be able to use your services, or they have to go to someone local?
You can use someone local. It's just a matter of getting licensed in the state that we're talking about. So Indiana, Illinois, Florida, Ohio, Michigan, all the states around me, I've got license, but it's case by case. So if I can help you, I love to.
Okay. You licensed in Florida?
Yes.
Okay.
Yep. Florida, California.
Thus the
yes,
Florida tan.
The tan, yes.
So,
we just saw each other in Florida.
That's right.
a couple
That's
weeks
right.
back.
I'm going back.
There you go.
Give me 2 frequently asked questions if someone wants to contact you.
Yeah, so the one that I get the most is what do I need to start with, and what's my number for retirement? I remember Fidelity had those.
Yes, I want you to put a pin there, because I know my audience. We found. I'm feeling somebody saying, how much do I need to start, which you covered, and then how do I have to cut you a check? How much is your like that? Let's start right there.
How do I get paid? Yes.
Exactly. Let's start right there.
Let's go to it. So there's a couple ways that I like to work with my clients. First one would be there's what we call a brokerage account. It's got essentially commissions. So if you need help understanding the markets, understanding how to put a portfolio together, how to get yourself to your retirement goals, then having and working with a professional is, in my opinion, one of the best things you could do.
I agree.
If you're like Larry and you understand the markets and you do a good job with it yourself, then go for it, right? Mm-hmm. Have your fun with it. Enjoy yourself. Don't lose too much, right?
Right.
My wife.
Discipline.
Yes.
Discipline.
Yes. My wife knows when I lose some money, and she also knows when I gain it. So
yeah. You're like, yeah.
Some accountability there, but as far as working with someone, again, if you need help, right. I am here for you. But finding someone that you can trust, that's so vital. It's so important. So
do you have people, like some people that have their own portfolios, right?
Oh, yes.
And so they have their own portfolios, but they think a licensed broker may help them. Do they have to sign up with you for life, or could they meet with you for a certain time or a certain period?
I always say my clients are the boss. You're in charge. So first of all, having your own account, absolutely. I call it play money and serious money.
Yes.
So play money is the money that if my wife finds out that I lost $2,000, $5,000, $10,000, it's like, okay, it is what it is. But if I bet the farm on a retirement money on one thing and it goes out the door, that's not okay, right?
You'll be knocking on the door, Uncle Larry, I need a room.
Yes, we don't want that. So as far as serious money, that's where I would say, don't bet the farm, don't play with it. You want to be very strategic, and that's where I feel that I add the most value. So, but don't let me get away from this cost question. So, as far as how I get paid, again, two ways. The first one is commission. So, if we place a trade, on a stock or a mutual fund, an ETF, then I would get paid on that one. And then we've also got a fee-based account. So
when you say you'll get paid on that, do they cut you a check, or you actually perform off the performance of the stock? You actually get paid off of the, I want to be real clear.
Yes, so I would get paid from when we place the trade. So as an example, if we did $10,000 and it was, I don't know, a 1% commission, then I would get the 1%, the 100 back, the $100 to me, and then your money gets invested. That's not in the form of a check.
Right.
Most often it comes out of the investments.
There you go. And that's very cheap to have a licensed professional that knows what they're doing. Right. Extremely cheap.
Yep. So that's commission, and then the fee-based one. Annually speaking, there would be a percentage charge that comes out. Right. And then you don't have to, again, write a check or anything. It comes out of your investments, your portfolio. But there is a lot of value added as far as what we're doing, as far as communicating about the performance, the markets, talking about what we see going forward, and really the biggest thing, in my opinion, is creating a financial plan.
Right, and then you are licensed with the state, so it's not like Joe Blow or whatever. This is a safe. What's the name of the company you work for?
Edward Jones.
Okay. Larry Jones. Edward's my cousin. I wish.
Here you go.
So, give them your contact information.
Yes, my email is alec.rosario@edwardjones.com.
All right. I know some people are asking, isn't this what Larry does? And I'm about bringing you as much information as I possibly can. We want to have the proper tools to equip you for financial freedom and to create generational wealth. That's what I'm about. And so I'm going to be reaching out to other people. I'm going to be doing live streams with other people, that anything that I think will help to put you on that path, that's what I'm going to do. I know this one's a little bit long, but stay tuned, because the next one we're going to be talking about is what did I say we're going to be talking about?
IRAs.
IRAs. That's it. See, I'm old enough to be his uncle, good people. So that's where we are, okay? We're going to catch you on the next one. Live, love, laugh, and learn.